Okay, so you want to own a data center. Find some land, pour some concrete, fill it with servers, and watch the AI money roll in. That's the pitch every developer is pitching investors right now. Here's the problem. Half the data centers being built this year will never turn a profit. And it's not because AI demand disappears. It's because of something nobody in the pitch deck ever mentions. Power. Walk past one of these buildings and it looks like the safest bet in modern real estate. One massive tenant, usually one of the biggest companies on the planet. A long-term lease, sometimes running 10 or 15 years. Guaranteed rent, guaranteed growth, guaranteed relevance for as long as the internet exists. That's the story on the cover of every investor deck getting passed around right now. Here's what the deck doesn't say. A data center isn't really a real estate business. It isn't really a technology business either. It is an electricity business that happens to have servers sitting inside it. And once you understand that, every number in this industry starts to make a very different kind of sense. Let's start with what it actually costs to build the thing, because pour some concrete is doing a lot of hiding in that sentence. The first number that matters is cost per megawatt, not cost per square foot. A standard enterprise-grade data center runs somewhere around $10 to $12 million per megawatt of power capacity to build. That figure has been climbing hard. The global benchmark for a standard shell and core facility hit roughly $11.3 million per megawatt this year, up almost 47% in just 6 years. And that's the cheap version. An AI-optimized facility, the kind built for dense GPU clusters instead of ordinary servers, needs heavier electrical systems and liquid cooling instead of fans, which pushes the shell and core cost up another 7 to 10%. Add the cost of fitting the building out with the actual tenant technology inside it, and a fully built AI-ready facility can land north of $37 million per megawatt once everything is accounted for. Multiply that by a modest 50 megawatt facility, and you're looking at somewhere between $550 million and $1.8 billion before a single server has been switched on. That is not a typo. That is the entry fee. Here's the part that trips up almost everyone who's never worked in this industry. You'd assume the expensive part is the land or the building or the chips. It isn't. The single biggest line item is electrical infrastructure. Transformers, switchgear, backup generators, battery systems, which alone can eat 40 to 45% of the total construction budget. Cooling adds another 15 to 20% on top of that. You are not really building a warehouse with computers in it. You are building a small power plant that happens to have a server room attached. And that power plant needs power from somewhere, which is where this business gets genuinely brutal. In most major US markets right now, the constraint isn't concrete or permits. It's the electrical grid itself. Interconnection queues, the waiting line to physically get your building plugged into the regional power grid, now stretch 4 to 7 years in hot markets like Northern Virginia, Phoenix, and Dallas. You can have every dollar of your $600 million construction budget sitting in the bank, and the local utility can still tell you your power won't be ready until the early 2030s. In an industry where the entire pitch is AI demand needs capacity right now, a multi-year wait for electricity is not a footnote. It's the whole ballgame. This changes how site selection actually works, and it inverts the logic almost everyone assumes going in. You'd think a smart developer hunts for the cheapest land. Wrong target entirely. Power availability now determines where a data center gets built before price per acre ever enters the conversation, which is why developers increasingly chase substations and transmission corridors instead of chasing discounted farmland. States have figured this out too, and turned it into a bidding war. A handful of states now offer sales and use tax exemptions on data center equipment, and electricity running as long as 35 years, provided you clear a minimum investment threshold, often somewhere north of $30 million, and a facility of at least 25,000 square feet. That exemption can be worth more to your bottom line over the life of the building than the land itself cost to acquire. But those incentives are also getting clawed back one at a time as state legislatures reconsider the trade. Several have already ended electricity-specific exemptions that used to be part of the package, which means the tax math you underwrote the deal on 3 years ago may simply no longer exist by the time the ribbon gets cut. Now let's talk about what it costs to keep the lights on once you're actually running, because this is where the quiet bleeding happens. Electricity itself is usually structured as a pass-through cost to tenants, which sounds like it protects you as the owner. It does and it doesn't. Power prices swing wildly by region, from around 4 cents per kilowatt hour in parts of Canada to nearly 18 cents in California. And every megawatt hour that gets more expensive to buy is a megawatt hour your facility has to somehow still deliver at a price your lease already locked in. Then there's cooling. A dense AI rack today can draw over 200 kilowatts by itself. That's more power than some entire small businesses use. And every one of those kilowatts turns into heat that has to be pulled back out of the building constantly 24 hours a day, or the hardware inside starts failing. The industry has a metric for this called PUE, power usage effectiveness, and even a well-run facility burns meaningful extra electricity just moving heat around before a single customer workload gets processed. There's also the cost that never shows up until the local news does a story about it. Water. Large facilities still using evaporative cooling can consume hundreds of thousands of gallons a day, and in drought-prone regions, that single fact has become the fastest way to turn a quiet zoning hearing into a packed town hall full of angry neighbors. Some operators are shifting to closed-loop liquid cooling, specifically to avoid that fight, but closed-loop systems cost more to install and more to maintain, which means dodging the water controversy just moves the expense somewhere else on the ledger. Insurance follows the same pattern, a single building housing hundreds of millions of dollars in electrical and computing equipment, running continuously in a facility increasingly targeted by both cybercriminals and local activists, is not a cheap policy to underwrite, and premiums across the entire commercial infrastructure sector have been climbing for years. Then there's the cost nobody puts in the brochure: obsolescence. A data center built in 2023 for air-cooled servers is, in the eyes of a hyperscale tenant looking for the newest AI chips, already something close to a technological dinosaur. Unlike an office building, you can't just repaint the walls and release the space to somebody else at a discount. If your facility can't deliver the power density the next generation of chips needs, the entire building's revenue potential quietly craters, even though nothing about the concrete or the wiring has physically changed. This is why so much of this industry has shifted toward complex financing structures. Special purpose vehicles that keep massive data center debt off the parent company's main balance sheet. Roughly $120 billion of AI data center debt has reportedly been shifted into these structures industry-wide. It's not illegal. It's not even unusual for infrastructure this large. But it does mean a lot of the real risk in this business is sitting somewhere investors can't easily see it, tucked one layer away from the headline numbers. So how does the building actually make money? This is where the layers start to look a lot like every other real estate business you've ever heard broken down, just with a much bigger power bill attached. The first layer is base rent, except in this industry it's quoted as dollars per kilowatt per month instead of dollars per square foot per year. In the biggest markets, Northern Virginia and similar Tier 1 hubs, that rate runs somewhere around $370 per kilowatt per month as of this year. Run the math on that. 1 megawatt, leased at that rate, generates roughly $4.4 million a year in revenue from a single megawatt of capacity. That's the baseline, ordinary server room number. Now compare that to what dense AI-optimized GPU capacity is reportedly commanding in the same footprint, anywhere from $10 million to $60 million a year per megawatt, according to industry unit economics estimates circulating this year. That's 2 to 13 times more revenue squeezed out of the exact same unit of electricity just by swapping ordinary racks for dense GPU clusters. That single fact is the entire reason every major operator on Earth is racing to build AI-dense capacity instead of ordinary colocation space. The power doesn't get any cheaper. What you're allowed to charge for it gets dramatically more expensive. The second layer is the deal structure itself, and this is where owners make a bet that shapes everything downstream. Retail colocation, leasing smaller amounts of space and power to a wide mix of customers, commands the highest per kilowatt rate and the fattest margin, typically 55 to 65%, because you're bundling in cross-connects, security, and managed services customers will pay a premium for. Wholesale colocation, leasing tens of megawatts to a single hyperscaler for 5 to 15 years, runs a thinner margin, usually 40 to 55%, in exchange for enormous contract size and long-term certainty. Retail is a farmer's market. Wholesale is one customer buying the entire farm. Most large facilities end up choosing wholesale for the same reason a rancher sells to one slaughterhouse instead of standing at 100 farmers markets. Certainty beats margin when the fixed costs are this large. There's a third, smaller layer sitting on top of both of those, And it works almost exactly like the kiosk in the middle of a shopping mall. Tiny footprint, disproportionate return, cross-connect fees, the charge for physically wiring one tenant's equipment to another's inside the same building, run anywhere from $50 to $300 per connection per month. It sounds like pocket change until you remember a single cable takes up essentially zero floor space and zero power draw, which means the margin on it is close to total. Add remote hands service fees, charged whenever a tenant needs an on-site technician to physically touch their own equipment, and you've got a small but genuinely high-margin business, running quietly inside the much larger, much thinner margin business of leasing raw power and floor space. And that brings us to the single scariest number in this entire industry, tenant concentration. Because when your facility has one hyperscale tenant paying the bills, you haven't built a diversified business. You've built a single tenant office building with better air conditioning. Which brings us to what's actually happening across this industry right now, in real time. Take a company called CoreWeave. It's not a landlord in the traditional sense. It leases and operates AI computing infrastructure across a network of data centers, but its numbers are the cleanest window into exactly the risk this whole industry is carrying. As of the most recent disclosures, CoreWeave was sitting on roughly $24.5 billion in total debt once off-balance sheet leases were included, with $7.5 billion in interest payments alone due through the end of this year. And here's the number that should stop you cold. 62% of the company's entire revenue came from a single customer. One. If that one customer decides to shift workloads in-house or simply negotiates harder on renewal, a business carrying tens of billions in debt loses more than half its income in a single conversation. This is not a hypothetical. Weeks after its own public stock offering, the company went back to the debt markets to raise another $1.5 billion, which tells you something about how tight the cash situation already was. This off-balance sheet habit isn't limited to smaller debt-heavy operators either. Even Meta, one of the wealthiest companies on the planet, had a Louisiana data center flagged as a critical audit matter by its own outside auditor earlier this year. Not because anything illegal happened, but because the accounting judgment involved in how that facility's debt gets classified was significant enough that the auditor felt obligated to call it out by name. When your auditor singles out one specific building in a company worth over $1 trillion, that's worth sitting with for a second. And on Wall Street, data center debt has quietly become one of the fastest growing corners of the commercial mortgage bond market, now making up more than 1 in 10 new single-borrower commercial mortgage securities issued. Investors buy those bonds partly on faith in the tenant's name. If a hyperscaler is the one paying rent, the assumption is the debt must be safe. That is precisely the same assumption that underpinned mortgage bonds in 2008, right up until the tenants underneath them stopped being the thing anyone was actually underwriting. CoreWeave isn't an outlier, it's a preview. Because zoom out from any single company and look at the industry pipeline as a whole, and the picture gets worse, not better. Independent trackers estimate that somewhere between 30 and 50% of all U.S. data center capacity scheduled to come online this year will be delayed or canceled outright. Of roughly 16 gigawatts of planned capacity, only about 5 gigawatts is actually under construction right now. The rest is stuck, waiting on grid interconnection, waiting on transformers and switchgear that are back-ordered industry-wide, or increasingly, waiting on a fight with the local community that doesn't want a power-hungry building next door. Cancellations driven by local opposition alone reportedly quadrupled last year. Even the largest, best-funded project on the planet isn't immune. One $500 billion data center campus, backed by some of the deepest pockets in technology, had reportedly shown no significant physical progress on site as of earlier this year, stalled by the exact same power and equipment bottlenecks choking smaller developers. And it's not just permitting delays anymore. Entire state legislatures have started voting to slow this industry down directly. One state assembly voted by a wide bipartisan margin this year to freeze new data center development inside its borders for the next several years. When you can raise unlimited capital and still can't get your project built, that tells you the constraint was never money. It was always power, people, and patience. 3 things no amount of investor enthusiasm can manufacture faster. So let's actually run the numbers on what this business looks like if you build one yourself. Say you develop a 50 megawatt standard tier facility. Construction lands around $565 million at this year's benchmark rate. Say you put 30% down and they finance the rest over 15 years. Your annual debt service alone runs somewhere in the neighborhood of $45 to $55 million a year before you've paid a single employee or cooled a single server. In the optimistic scenario, you lease the entire 50 megawatts to blue-chip tenants at a blended rate of around $200 per kilowatt per month, a reasonable mid-market number once you mix wholesale and retail deals. That's $10 million a month, or $120 million a year in gross revenue. After operating costs, staffing, security, maintenance, and the slice of electricity costs you absorb, rather than pass through, typically 15 to 20% of revenue, you're left with roughly $95 to $100 million in operating income. Subtract your debt service, and you're clearing somewhere around $45 to $55 million a year in genuine profit. On paper, that's an outstanding business. Full occupancy, blue-chip tenants, a return that would make most real estate investors jealous. In the realistic scenario, 2 or 3 things go wrong that aren't exotic at all. Your grid interconnection, originally promised in 3 years, slips to 5, so you're paying construction debt service for 2 extra years with zero revenue coming in. Call that an extra $90 to $110 million in carrying costs before you've leased a single kilowatt. Your anchor tenant, the one covering 60% of your capacity, renews on tougher terms after threatening to walk to a newer, liquid-cooled facility down the road, cutting your blended rate by 20%. And 2 of your smaller retail tenants leave when their contracts end, unwilling to pay a premium for a building that's already a few years behind the newest cooling standard. Your revenue drops to somewhere around $85 million a year. Your operating income shrinks to $65 to $70 million. After debt service, you're left with $15 to $20 million a year, against $565 million in invested capital. The building didn't change. The tenants are still real companies. Nothing dramatic happened. The gap between your good year and your bad year is still worth $80 million, and almost none of it shows up as a single visible event. Just a slower interconnection, a tougher renewal, and a building that quietly stopped being the newest option in town. That's the real shape of this industry right now. Guaranteed sounding revenue built on top of a tenant list that's shorter than a strip mall's, financed with debt that gets bigger every year construction gets delayed, sitting on a power grid that takes longer to expand than the hardware inside the building takes to become outdated. None of this means the industry collapses tomorrow. Underlying demand for cloud computing, streaming, and ordinary enterprise workloads isn't going anywhere, and that baseline keeps even a struggling facility from going to zero, the way an empty mall eventually does. But baseline survival and the returns investors are currently underwriting are 2 very different numbers, and the gap between them is exactly where the next few years of this industry are going to get decided. The AI boom is real. The demand for compute is real. But a data center was never really a bet on artificial intelligence. It's a bet on a power grid, a handful of tenants, and a construction timeline, all staying roughly on schedule at the same time. And in this business right now, roughly half of them aren't.